Because interest rates are the main instrument used by the Federal Reserve, the US Central Bank, to regulate inflation, both inflation and interest rates frequently move in the same direction. The Federal Reserve Act mandates that the Fed work to increase employment and maintain price stability. In order to fulfill the stable price element of its dual mandate, the Federal Reserve has set a target annual inflation rate of 2% since 2012. Because a protracted drop in prices, defined as deflation, can be much more damaging to the economy, the Fed aims for a positive rate of inflation, which is defined as an increase in the overall level of prices for goods and services. The central bank has the freedom to decrease rates in reaction to a slowdown in the economy thanks to the favorable levels of inflation and interest rates. Make sure to stay tuned until the end to find out more. Hey guys, welcome back to Economy Expert. Today in this video, we'll be discussing how and why raising interest rates help control inflation. But before we head over to our topic, make sure to subscribe to our channel Economy Expert for more such economy content. That said, let's take a closer look. The Consumer Price Index is once again rising after roughly 3 decades of comparatively modest inflation. According to data released on February 10, 2022, the price of gasoline rose by 40% from a year earlier in January 2022, while the price of used vehicles and trucks increased by 41%. Hotel rooms, eggs and fats, and oils are 3 more high inflation areas, with increases of 24%, 13% and 11% respectively. Prices increased by 7.5% on average, which is the fastest rate of inflation since 1982. The US Federal Reserve has a mandate to keep inflation from getting out of control and to bring it back to its preferred rate of roughly 2%. In order to accomplish this, the Fed has said it will increase interest rates several times this year, maybe as many as 5 times starting in March. And January's higher than expected inflation numbers imply that it might need to speed up its overall schedule. Will this function? Why? If so, rate hikes decrease demand. The federal funds rate, also known as the Federal Reserve's target rate, is under the supervision of the central bank. This is the interest rate that banks employ when lending money to one another overnight. Banks borrow money to provide loans to customers and businesses, sometimes from one another. Therefore, when the Fed increases its target rate, banks that need money to borrow or to meet regulatory requirements pay more to borrow that money. Naturally, banks pass these greater expenses forward to customers and companies. Accordingly, if the Fed increases the federal funds rate by 25 basis points or 0.25 percentage point, businesses and consumers will also pay more for borrowing money. The exact amount of the increase will depend on a number of factors, such as the loan's maturity and the bank's desired profit margin. This higher borrowing cost reduces the demand and slows economic growth. For instance, if the cost of a car loan rises, you could decide it's not the best time to purchase the new convertible or pickup truck that you've had your eye on. Or perhaps if the interest rate on a loan to finance it rises, a company will be less likely to invest in a new factory and recruit more employees. This is the price that the Fed's interest rate increases put on the economy. And decreased demand brings down inflation. This is precisely what decreases the rate of inflation at the same time. The prices of goods and services often rise in response to increased demand. However, as borrowing costs rise, there is a decrease in demand across the economy for goods and services. Although prices may not always decrease, the rate of inflation will typically decrease. Consider a used car dealership, where the rate of inflation has been particularly rapid throughout the pandemic, to get an idea of how this works. For the time being, let's assume the dealer has set inventory of 100 vehicles available on its lot. Demand will decrease as fewer buyers visit the lot if the overall cost of purchasing one of those cars increases due to an increase in the interest rate on the loan required to finance one. The dealer will probably need to lower prices to attract customers in order to sell more cars. The dealer also has to contend with greater borrowing costs and slimmer profit margins as a result of price reductions, which may prevent it from hiring all the staff it had planned to, or perhaps force it to fire certain employees. Since fewer people may be able to even manage the down payment as a result, the market for cars may be further diminished. Consider a $24 trillion US economy experiencing a drop in demand rather than a single dealer. Interest rate increases of any size can have repercussions that dramatically slow down economic activity, restricting businesses' capacity to raise prices. The dangers of rapid rate increases. But in our example, a fixed supply is assumed. As we've seen, there have been significant supply chain disruptions and shortages affecting the world economy. Additionally, these issues have increased production costs globally. the Fed may need to significantly boost interest rates to control inflation if the major causes of the high inflation in the United States are these higher manufacturing costs and low inventories. Furthermore, the economy will suffer more from the Fed's rate increases the higher and quicker they go. Using the example of a car, if computer chips, a vital component, are becoming more expensive due to the pandemic-related lockdowns in Asia, car makers will have to pass these higher costs on to consumers in the form of increased car prices independent of loan rates. In this scenario, the Fed might need to sharply increase interest rates while also significantly reducing demand in order to slow the rate of inflation. Nobody really knows at this time how high interest rates might have to rise in order to bring inflation back down to about 2%. The use of interest rates as a monetary policy. The federal funds rate is the main instrument of monetary policy used by the Federal Reserve. The overnight rate at which banks lend to one another over relatively short periods of time is known as the federal funds rate, which has been set as a range since 2008. In the past, the Federal Reserve has adjusted the amount of reserves available to the banking system and maintained a target federal funds rate through open market operations or the buying and selling of assets. Banking reserve rules put in place to guarantee the stability of banks led to a demand for reserves. The emphasis of bank regulation switched to capital buffer requirements and stress testing to maintain long-term solvency in the years after the global financial crisis of 2008. The Federal Reserve outlined a strategy to target the federal funds rate with 2 additional rates it set explicitly in 2019. The rate the Fed provides banks for overnight deposits in their Fed accounts is known as the Interest on Reserve Balances (IORB) rate. It establishes a practical floor below the Fed funds rate. Another instrument that offers a somewhat lower interest rate to non-bank money players in the market for overnight deposits is overnight reverse purchase agreements. The Federal Reserve will stop requiring banks and other depository institutions to maintain reserves in 2020. Because policymakers need data to predict future inflation patterns and the interest rates they set take time to completely impact the economy, both interest rates and inflation tend to move in the same direction but with delays. While slower economic growth frequently decreases the inflation rate and may lead to rate reductions, higher rates may be required to keep increasing inflation under control. By determining the interest rate it pays on bank reserve accounts, the Fed, among other things, sets a target range for the federal funds rate. Does increasing interest rates have any effect? Jerome Powell, the head of the Federal Reserve, has stated that he wants to more closely match supply and demand. But during the course of the epidemic, the worldwide supply chain for a wide range of items has been severely constricted, in part because of China's tight COVID-19 regulations from which many mass-produced commodities are obtained. The prolonged conflict in Ukraine has had a detrimental impact on the world's food supply, along with the natural gas and crude oil supplies that Europe mostly depends on. Therefore, the Federal Reserve may be limited in what it can do with the instruments at its disposal. According to Derek Tang, an economist with the macroeconomic consulting firm L.H. Meyer Incorporated, goods inflation is a trade and geopolitical issue that's managed by the whole government and not the Fed. We'll have to turn to the White House and Congress to take action on those matters, Tang said, whether that is negotiating agreements with other nations to ensure we have a better supply or more access to supply. And that's all for today. Thanks for watching. Do you guys think that this is the best action to curb inflation? Let us know in the comment section. And if you enjoyed this video, then please like, share and subscribe to our channel Economy Expert for more such amazing content.